The FNB House Price Index showed a further acceleration in April, up from a revised March growth rate of 8.1% to 8.6% year-on-year. This is the highest year-on-year growth since June 2010. Still means that since the real house price peak reached in February 2008, real house prices adjusted for CPI inflation over the period were 12.6% lower at March 2012. Now we get the gist of these numbers now with John Loos, who's the Household and Property Sector Strategist at FNB. John. It seems cheerful, and you say the highest year-on-year growth since June 2010, 8.1 to 8.6. Is this the beginning of an accelerating trend?
I don't think so, David. I must admit, it's pleasantly surprised me. I'd expected figures to stay in lower single-digit figures. What's been happening over the last few years since all the euphoria in the market ended with the recession is the ups and downs have just broadly been tracking the economy, and the economy's gone through some minor fluctuations. We had a recovery out of recession in 2009, 2010, then a bit of a slowdown. Then last summer, some uptick in economic growth. A slowdown in the winter and an uptick in the summer again, and pretty much the same has happened with house prices. They've gone through three such sort of ups and downs since the recession days. So just ticking along as the economy does. We know that economic growth in the fourth quarter last year was better than the previous two quarters for the world and for us. So just a slightly better economic period. The manufacturing PMI up until a few months ago had also seen some improvement, and I think that's it. Going forward, I'm not convinced that this is sustainable, because I'm not convinced that the global economic recovery is on a sustainable path yet. US growth slowed in the first quarter. Europe, there's more and more talk of recession. So it's a troubled world in which we live. And I think so, therefore, that this little mini recovery in house price growth will probably run out of legs and slow down into single digits again.
Then think of two aspects that generate prices. One is the confidence of people that they're going to be able to buy a house and pay it off. And of course, the other aspect is the bank's readiness to lend. So firstly, consumer confidence in this, because people pulled back. Even if they might think that they could afford a new house or to buy a house, they hung back. And of course, interest rates possibly will go up, but they haven't gone up. So is this meaning more confidence in the consumer?
I think so. I like to talk about the so-called recency bias, where people's perception of risk is determined far more by recent events than events further back in the distant past. I think the recession is fading in the memories, not only of the home buyer, the borrower, in a lot of cases, but also in the case of the lender. Yeah. And my perception is possibly the banking sector as a whole might be getting a little bit more confident, because we've had a nice stable time with interest rates and reasonably okay with economic growth for quite some time now. So yes, I think that confidence on both sides is possibly just built up a bit.
I like the word you've just invented. I've not heard it before. Recency. The recency.
I didn't invent it. It is talked about by the behavioural economists.
New to me. You talk about investments by household and net income from property, a Reserve Bank term. Now, that's a new term to me. Explain that. Yes.
If we look at disposable income growth, what we've seen is that wage bill growth, according to the SAR, by late last year was only growing at about just over 8% year on year, and it had slowed a bit. But what's been keeping disposable income growth accelerating through 2011 seems to be that component of income that comes from investments. Investments being dividend payouts from rental and from interest-bearing deposits. And that has grown very strongly, a lot stronger than the wage bill growth, up nearer to 16% for 2011 as a whole. And so we've seen this year-on-year acceleration in nominal disposable income growth throughout 2011 to around about 11.3% year-on-year by the fourth quarter of last year, which is a lot higher than wage bill growth. And I think that has something to do with this relatively good period in housing too, that yes, employment has improved a bit, but on the other hand, wage inflation has probably tapered off, so the wage bill isn't going places as fast. But what's kept it going is just this lagged response to the economy ending its recession, company performance is doing better, and therefore investment returns and income received from investments doing significantly better in 2011, and that's for a portion of the household sector that's been particularly good.
How big would that market be? Because one also gets the impression that consumers were really slammed, they're still paying off debt. A lot of them perhaps don't have any income from investments of the kind that you mentioned.
Well, that's true. On the lower end, you would think they're more interest rate sensitive and are benefiting far more, I think, just from very low and stable interest rates. That would be more a higher end. As you go up the income ladder, that would probably be more relevant, is that investment income source.
You've been doing this for a time now, and you talk about mini surges, and I suppose you touched on it a moment ago, but you're saying now, if one likes to sort of distill it, this is the third mini surge.
Yes, interest rates came down rapidly in 2009 till August 2009, and we had the first surge in house price growth out of deflation back in the recession. Things started to taper off, and then came last year's summer, 2 quarters of relatively good economic growth globally and locally. That lifted the housing market just a little bit, and we had faster price growth. That started slowing again as we went into the winter quarters last year, and then again in the summer, the third, as I call it, the mini surge, up we go again, just slightly better. I think one must get it in perspective though. 8.6%, as I say, I don't think it's going to be sustained at these levels. It is positive in real terms, but it's not a wildly exciting market at the moment. It's better, but it's certainly not boom times.
You also take a longer view, and you don't always look at the price levels of a long time ago, and you look at your index in July 2000, so we're going back 12 years. Real price is 70% higher now, and nominal price 231% higher. Those seem big amounts, but it is more than a decade.
Well, yes, but look, the 231% in nominal terms doesn't mean a lot. You've always got to adjust for inflation. But the 70% higher shows that we still, relative to our history, we're still an expensive property market, even though we've had some real price decline since 2008. But we're still in the more expensive times if we look back over the last 40 or so years of recorded property history.
Looking at the nominal amount, of course, it is important for people who've bought a house, if there is inflation and they're paying off the bond, it gets steadily cheaper for them.
Well, yes, it's another reason why it's important to look at nominal growth. It's not entirely a meaningless figure, is because if you are paying off a bond, you want to know that you've got some sort of equity in your house, and so the nominal value of the bond stays fairly constant or runs down gradually with time. Nominal house prices inflate, and that means if you do get into trouble, as a lot of people still are, you can trade out and you can trade down if your house has inflated in nominal terms quite significantly without necessarily making a loss. According to our estate agent survey, roughly 20% of sellers are in that position where they are trading or they're selling in order to downscale due to financial pressure. The ones in 2008 struggle a bit more not to make a loss, but the ones who bought back a decade ago or so, if they are in financial trouble, wouldn't have too much of a problem.